A new silver squeeze emerges. It's not where you think, not London, not New York, not the trading floors that usually make headlines when precious metals move. This time, the pressure is building somewhere else entirely. A nation of over 1 billion people. A government quietly closing the door on imports, and a market that is running out of supply even as officials insist demand is falling. Something does not add up here. And by the end of this briefing, you will understand exactly why this matters, not just to that country, but to every investor, every saver, every business professional watching the global economy right now. Because when supply and official statements stop matching, that is usually the moment smart money starts paying attention. Stay with us. Welcome back to Precious Metals Intelligence. If you're joining for the first time, this channel exists to break down strategic developments in the global precious metals market, calmly, analytically, and without the noise. Before we begin, we'd love to know, where in the world are you watching from today? Drop your city or country in the comments below. This audience spans the globe, and it's always worth seeing just how far this reaches. In the middle of this year, a government made an announcement. On the surface, it sounded routine. It sounded like the kind of policy update that gets read once, forgotten, and buried under bigger headlines. The government said it was placing new restrictions on the import of a precious metal. Officials described this as a normal step. They said it was needed to protect the country's foreign currency reserves and to support the national currency, which had been under pressure. That was the official story. And for many people watching global markets, it seemed like nothing more than routine housekeeping. Governments adjust trade rules all the time. They raise duties, they add paperwork, they tighten categories. Most of these moves come and go without lasting consequences. But this one was different. And the difference did not show up in the announcement itself. It showed up in what happened afterward. The country in question relies on imports for the overwhelming majority of its silver supply. Analysts estimate that more than 80% of the silver used domestically comes from overseas. This is not a small dependency. It is the foundation of an entire market, one that touches jewelry makers, investors, industrial manufacturers, and everyday savers who buy silver as a store of value. So when the government tightened the rules, it was not adjusting a minor detail. It was reaching into the core of the supply chain. At first, the restrictions applied broadly, covering most forms of silver entering the country. Then, just weeks later, the government went further. It expanded the restricted list to include silver in grain form and silver in powder form, materials used heavily by industry. Prior authorization became mandatory before these could even be imported. Officials continued to frame all of this as fiscal caution, protect the reserves, support the currency, reduce the trade gap. On paper, these are reasonable goals for any government managing a national economy. But here's where the story stops being routine. At the very same time officials were tightening these restrictions, they were also telling the public that demand for precious metals was weakening. The message to citizens was simple. There is no urgent need to buy. Hold back. Demand is soft. There's no shortage to worry about. This is the moment worth pausing on. A government does not usually need to discourage people from buying something that nobody wants. If demand were truly falling on its own, restrictions would barely be necessary. Sellers would already be sitting on unsold stock. Prices would already be soft. The market would simply cool down without any need for intervention. Instead, the opposite began to happen. Even as officials described demand as weak, the price gap between domestic silver and international silver began to widen. Buyers inside the country were paying more for silver than buyers anywhere else in the world. That is not what a market with falling demand looks like. That is what a market with falling supply looks like. This contradiction is the heart of the story. On one side, a public message telling people that everything is calm, that there is no rush, that demand has softened. On the other side, a set of trade restrictions so aggressive that they choke off the vast majority of a nation's silver supply almost overnight. For business professionals and serious investors, contradictions like this are rarely accidental. When official language and market behavior begin to diverge, it usually signals that something deeper is taking place beneath the surface, something the public messaging is not fully capturing. So the real question is not whether this policy is routine. It clearly is not. The real question is this. If demand is genuinely falling, why does the market behave as though supply is disappearing? To answer that, it becomes necessary to move past the announcement and into the numbers themselves. The trade data, the import figures, and the widening price gap that reveals what official statements alone cannot explain. That is where this story goes next. Words from officials can shape a narrative. Numbers cannot be talked around so easily. And once the trade data for this story became public, the gap between what was being said and what was actually happening grew impossible to ignore. In May, silver imports into the country fell to just under 47 metric tons. To put that in perspective, the same month 1 year earlier saw imports of more than 500 metric tons. That is not a small dip. That is a decline of over 90% in a single year. Entire supply chains do not simply absorb a drop of that size without consequences rippling outward. Then came June. According to trade reports, imports fell even further compared to May. The restrictions introduced earlier in the year were not easing. They were tightening their grip month after month, and the domestic supply of silver was shrinking in step. For a country that depends on foreign silver for the overwhelming share of what it consumes, this kind of decline is not a footnote. It is a structural shock. Jewelers who rely on steady silver supply for production, investors who buy physical silver as a hedge against currency weakness, manufacturers who need silver for electronics and solar components, all of them draw from the same shrinking pool. And yet, for a short period, the shock did not fully show up in prices. Why? Because of a second, less visible development. Earlier in the year, the government raised import duties on both gold and silver, pushing the rate up to 15% from a previous 6%. That increase pushed many investors who were holding silver through exchange-traded funds to sell. As one bullion dealer explained, the higher duty made it more attractive to exit those holdings and lock in profits rather than continue holding. This wave of selling released silver back into the domestic market. For a brief window, that released metal acted like a cushion. It filled some of the gap left by the collapse in imports. The shortage was there, but it was partly hidden, softened by silver flowing out of investment funds and into general circulation. That cushion, however, was temporary. Once that reserve of released silver was absorbed by the market, the underlying shortage had nowhere left to hide. And that is precisely when domestic premiums began to climb sharply. By early July, bullion dealers reported that domestic silver was trading at a premium of $6.50 per ounce above the official international benchmark. That is more than 10% above the global price. Just 2 months earlier, in May, the situation had been the exact opposite. Domestic silver was trading at a discount of up to $5.50 per ounce below the international price. Read that shift carefully. In the space of roughly 2 months, the market moved from a meaningful discount to a meaningful premium. A swing of more than $10 per ounce relative to the global benchmark did not happen by accident. It happened because supply tightened faster than the market could adjust. At present, much of the domestic market is leaning on one major domestic producer to fill the gap left by collapsing imports. But one producer, however large, cannot easily replace what was previously supplied by imports covering the vast majority of national demand. As demand continues to show signs of recovery, dealers are already warning that premiums are likely to climb even further. This is the part of the story that official statements did not fully explain. Reduced imports. A brief masking effect from ETF outflows. Then a sharp, visible premium once that cushion ran out. Together, these numbers tell a very different story than the one suggested by public reassurances that demand was simply weak and there was nothing urgent to watch. For anyone trained to read markets rather than headlines, this pattern is familiar. It has appeared before, in a different form, under different circumstances, and understanding that earlier episode is essential to understanding what may be building right now. That earlier chapter is where this story turns next. To understand what may be building now, it helps to look back a few years, to an earlier chapter in the silver market that many investors still remember well. Back in 2021 and 2022, the silver market experienced what became known as a physical squeeze. At that time, everyday buyers around the world began purchasing large amounts of physical silver at the same time. Their goal was simple. They believed that large financial institutions were holding short positions in silver, and they wanted to force those institutions to cover those positions by buying up available physical supply. This period became known among precious metals communities as the original silver squeeze movement. The effect on the ground was dramatic. Bullion dealers found themselves short of physical inventory. Coins and bars became difficult to source. Prices for physical silver rose well above the price quoted on paper markets. Buyers were willing to pay steep premiums simply to get their hands on real physical metal, even as the officially quoted price stayed comparatively lower. Some dealers even began selling large bars in smaller cut pieces, just to meet demand from buyers who could not find anything else available. That earlier squeeze was driven almost entirely by public behavior. It came from the bottom up. Ordinary buyers, often organizing informally, chose to act together, and that collective action changed the market. What is happening now is different in one very important way. This time, the squeeze is not coming from millions of individual buyers making a coordinated choice. It is coming from the top down. It is being driven by government policy. This distinction matters more than it might first appear. A retail-driven squeeze, like the one seen previously, tends to ease once public enthusiasm fades. Buyers eventually slow down. Prices adjust. The market gradually returns to balance because behavior at that scale is naturally uneven and hard to sustain over long periods. A squeeze driven by government policy behaves differently. It does not depend on public mood. It does not fade when enthusiasm cools. It continues for as long as the policy remains in place because it is being enforced through official rules rather than personal choice. Import restrictions do not lose motivation the way individual buyers sometimes do. They stay in force until a government decides otherwise. This is why a state-driven supply squeeze deserves closer attention from serious observers than a retail-driven one. It is more structural, it is more durable, and because it flows directly from national policy, it is also tied to broader economic goals, such as protecting currency value and managing trade balances, which tend to shift slowly and deliberately rather than overnight. There is also a deeper layer worth noting. In the earlier squeeze, silver was primarily viewed through the lens of investment sentiment, a commodity that people chose to buy because they believed in its value. In this current episode, the metal is being treated differently by the government itself. The restrictions suggest that officials view silver alongside gold as something closely tied to monetary stability, not simply as a traded commodity. When a government restricts a metal to protect its currency and its reserves, it is implicitly treating that metal as a monetary asset, one capable of influencing national financial stability. This is a meaningful shift in framing. It suggests that policymakers are not simply managing a trade category. They are managing something they consider strategically important to the country's financial position. For professionals watching global markets, this distinction between a public-driven squeeze and a policy-driven squeeze is critical. One tends to be temporary, tied to sentiment that rises and falls. The other tends to be structural, tied to decisions made at the national level and slower to reverse. And when a policy-driven supply squeeze takes hold in a country that represents such a large share of global silver demand, its effects rarely stay contained within that country's borders. And what begins as a domestic policy decision has a way of reaching outward, into international pricing, into global supply chains, and into markets far beyond where the original decision was made. A policy decision made inside one country rarely stays inside that country. This is especially true when the country in question represents one of the largest sources of demand for a globally traded commodity. What happens next in the story is not really about one nation's import rules. It is about how those rules begin to influence markets far beyond its borders. To understand why, it helps to think about scale. This country is not a minor participant in the global silver market. It is one of the largest consumers of silver in the world, driven by jewelry, coins, bars, and a growing base of investors using silver-backed financial products. When a market of this size suddenly restricts how much silver can enter, the effects do not simply disappear, they shift somewhere else. Either the metal stays outside the country and adds to global supply elsewhere, or the shortage inside the country begins to pull attention and eventually price pressure back toward the international market. This is where the paradox becomes important, and it is a paradox that professionals should sit with carefully. Officials describe demand inside the country as weak. On paper, weaker demand should ease pressure on prices, both domestically and globally. But that is not what unfolded. Instead, reduced imports collided with recovering underlying demand, and the result was a rising, not falling, domestic premium. Less buying did not mean lower prices. It meant a tighter, more strained market because the restriction targeted supply directly, regardless of what demand was doing. This is a distinction every serious investor should hold on to. Falling demand and falling prices are not always the same thing. When supply is deliberately constrained by policy, prices can rise even while demand cools, simply because the available pool of metal shrinks faster than buying interest does. Assuming the two always move together can lead to significant misjudgments about where a market is actually heading. There is a second development unfolding at the same time in a different part of the world that adds further weight to this story. Elsewhere, discussions are underway to classify silver as a critical mineral, a designation that would recognize its strategic importance beyond its use in jewelry or investment. Some analysts suggest this could eventually lead to a form of pricing floor, a level below which certain buyers would be unwilling to source the metal for less, or a boundary shaping how much certain governments are willing to pay to secure supply for critical industries. Taken individually, each of these developments might seem like a regional story. One country tightening import policy to protect its currency, another country beginning to treat a metal as strategically important for its industrial and technological future. But taken together, they form a broader pattern. In different ways, and for different reasons, governments are beginning to treat silver less like an ordinary traded commodity and more like a strategic resource, one worth protecting, restricting, or securing deliberately. For business professionals and long-term investors, this pattern deserves attention precisely because it is not built on speculation or short-term sentiment. It is built on policy decisions, the kind that tend to move slowly, remain in place for extended periods, and shape markets gradually rather than overnight. When multiple governments, independently and for their own domestic reasons, begin treating the same metal with this level of strategic caution, it becomes worth asking a broader question. Is this a temporary, isolated set of policy choices, Or is it an early signal of how precious metals may be viewed and managed in the years ahead as nations navigate currency pressures, trade imbalances, and the search for financial stability in an uncertain global economy? That question is where this briefing turns next in its final and concluding part.